Well, joining us now with more on what the Fed's bold action means for the markets and the U.S. economy is John Allison, founder, chairman, and CEO of UNIO Holdings. That's an asset management company that buys and transforms operating companies in various businesses. John, thanks for joining us.
Thank you.
So, John, the Fed is going to buy mortgage-backed securities at a pace of $40 billion a month indefinitely. And I think that's the key word here. What does this notion of indefinitely signal?
I think it is the key notion, and I think it signals the fact that the Fed has reached the point where it is running out of options. And so one of the options is to deal with time, and one way to deal with time is to say it goes on forever.
Does that send a signal that the Fed is kind of taking a shot in the dark, not really knowing what's going to work, what is going to work?
I completely agree with that. I think it's a trial and error business. This is the first time, I think we discussed before the show, in history that we've actually had a situation like this. So I think the Fed is doing what people do when they are encountering something for the first time. They're trying everything they can, and they see what sticks.
Now, for the 12.5 million plus Americans that are unemployed, what does all of this mean to them? How does this work in helping them get back into the workplace?
I think the Fed hopes that it's going to help them get into the workplace. I think that's its intent. My own view is that it's going to have a limited effect on getting them back in the workplace, because all it's really doing is lowering the cost of money and allowing people who deal in financial assets to sell things to the Fed. So in the end, I think the problem is you're not getting to the core thing, which is companies with assets that can be more productive, that can therefore hire people and put people back to work.
Because we had QE1, we had QE2, now we have QE3, now we have interest rates going from 2013 to 2014 to 2015, and banks still aren't lending.
Right.
Mortgages are at an all-time low, but banks still aren't lending. So is this going to now help banks loosen up the purse strings?
I don't think so. I think it's going to help banks' profitability. You know, it makes it easier for a bank to be a bank. Their cost of funds is low. They can sell assets to the Fed. I think the real problem is fundamentally that the banks actually lack the confidence to lend. They're actually hoarding capital. They're trying to replace their earnings. And so I think that's part of the reason why this well-intentioned effort is going to have trouble gaining traction.
And it's a very valid point that you make, hoarding capital, because we've got a lot of the big companies hoarding capital, the banks hoarding capital. So it seems like the stock market is benefiting, Wall Street is benefiting, but Main Street isn't getting the results. What needs to be done? What is the plan here to get Main Street to feel the effects?
Actually, I think there is an attempt to make the monetary policy help Main Street, but in the end, I don't think it really is the thing that produces the plan that helps Main Street. That's really the problem. I think ultimately, the only thing that helps Main Street is going to have to come from a combination of the innovative spirit of the economy and fiscal policy, which is going to have to settle itself to actually produce long-range confidence, so that all the companies that actually hire people have that long-range confidence to do what they need to do to hire.
If it's not going to help, there's also concern that it could hurt. There's talk about inflation. There's also talk about a Bernanke bubble, if you will, in the stock market, that at some point it's going to drop. What are your thoughts on that?
I'm not one of those people who fears the big inflation bubble. I think we're sitting atop a worldwide structural problem from China, Brazil, US, Europe. And so I think those who fear inflation are actually fearing something that is very unlikely to happen. I think there is more of a chance that what Bernanke is doing leads to all sorts of unintended consequences and misallocations of capital. Personally, I don't think it's going to be in the stock market. I think that's there's a wealth effect right now, but there are all sorts of places that capital is going that it probably shouldn't go, and I think that is a legitimate worry.
Now, you say as a historian that this is an unprecedented moment in history. Elaborate on that.
Well, first of all, as we were saying before the show, there's never been in the last 300 years a period where interest rates were this low. We've never had a period in the last 250 years where we've had structural change, structural stress interlinked the way it is around the world. So I think we're actually in a position where we're actually facing, as I said to you before, a set of unknowns, both on the interest rate front, the monetary policy front, the structural change front, and now being added to that as a political risk element that really is highly unusual. And in fact, I've never seen it from an interest rate perspective any time in the past 300 years.
Okay, so overall, this hasn't exactly calmed your fears.
in a certain sense, I'm not a very fearful person. So what I would say is I salute anybody trying to make things better. I salute the Fed for doing it. I don't think this is really something that's going to have a big effect.
All right. Well, thank you so much for that insight to John Allison, founder, chairman, and CEO of UNIO Holdings.